4 days ago, every financial headline celebrated peace. The Strait of Hormuz was open. Iran's foreign minister announced commercial vessels could transit freely. Oil crashed 10%. Stocks hit all-time highs. Silver jumped toward $82. That lasted exactly 36 hours. Right now, Monday, the April 20th, 2026, silver is trading at $79.31, down nearly 2% from Friday's close. Oil is surging 7.14% to $89.94. The Strait of Hormuz is closed again. U.S. Marines are holding an Iranian ship in the Gulf of Oman. And the ceasefire that markets celebrated last Thursday expires in 48 hours, with 0 confirmed talks scheduled. The peace deal was a lie, not because anyone deliberately deceived you, but because the two sides never actually agreed on anything fundamental. Markets priced in a resolution that did not exist, and silver is now paying the price for that misreading, while the physical market tells a completely different story underneath the surface. Tonight, I'm going to show you exactly how the lie unraveled, why silver dropped, and why the drop itself is based on a misunderstanding that is about to correct violently. Let me walk you through the timeline precisely because the speed of this reversal reveals everything about how fragile the peace narrative always was. Thursday, April 17th, at approximately 2 p.m., Eastern Iran's Foreign Minister Abbas Araghchi announced Hormuz was fully open to commercial traffic during the ceasefire period. Markets exploded. Oil crashed. S&P 500 hit its all-time high of 7,022. Silver jumped toward $82 Thursday evening. President Trump issued a statement clarifying that the U.S. naval blockade would remain in full force on Iranian-linked vessels. Iran said Hormuz was open. Trump said the blockade continues. Two statements, completely incompatible. Saturday morning, Iran processed Trump's statement and concluded the reopening was meaningless if U.S. warships were still blocking Iranian port access. Iran reinstated Hormuz restrictions. The IRGC declared all vessels subject to enforcement regardless of flag. Saturday afternoon, multiple ships came under attack from Iranian patrol boats. India's foreign ministry summoned Iran's ambassador after 2 Indian-flagged vessels were fired upon. Sunday night, USS Spruance intercepted and seized the Iranian cargo vessel MV Tuska in the Gulf of Oman after a 6-hour standoff. U.S. Marines fired into the engine room and boarded the ship. Iran's Joint Military Command called it an act of piracy and a ceasefire violation and vowed to respond. Monday, 6 a.m., COMEX opens. Silver gaps down from $80.50 to $78.94 in 60 seconds. 2% erased in 1 minute. The peace premium that built through Thursday and Friday evaporates instantly. Here's the core reason the deal was always fiction. This is what financial media completely missed. The U.S. and Iran have 2 fundamental disagreements that are not negotiating positions. They are constitutional and legal absolutes for both sides. Disagreement 1, nuclear enrichment. Trump's stated position is that Iran must abandon all nuclear enrichment above civilian levels and submit to full international inspection. Iran's parliamentary speaker, Kalibaf, stated on Sunday morning that nuclear rights are non-negotiable under Iranian law and international treaty obligations. There is no middle ground between those two positions. One side wins, or both sides walk away. Disagreement 2, the Hormuz blockade itself. The U.S. calls the naval blockade of Iranian-linked vessels a legitimate economic sanction. Iran's first vice president said on Monday morning, and I am quoting directly, "It is impossible for others to pass through the Strait of Hormuz while we cannot." Iran's position is that until their own ships can transit freely, no commercial vessel gets free passage regardless of flag. That is not a negotiating chip. That is a stated policy of reciprocal restriction. The April 17th announcement was not an agreement. It was Iran testing whether a goodwill gesture would produce U.S. reciprocity. When Trump refused to lift the blockade, the test failed and Iran reverted to baseline. Markets priced in a permanent agreement. What existed was a 36-hour test that failed. Now let me show you the Hormuz data that proves the Strait was never actually open even during those 36 hours. During the so-called open period from Thursday afternoon to Saturday morning, exactly 4 ships carrying dry cargo managed to transit the Strait. 4. Before the conflict began, over 100 vessels transited daily. The Strait was moving approximately 4% of its pre-conflict volume even during the alleged open period. Iran was charging transit tolls exceeding $1 million per ship during that window. Some reports indicated tolls as high as $1 million per barrel of oil transported. At those toll rates, virtually no oil tanker can transit economically. The math simply does not work for any commercially viable shipping operation. Markets saw the headline Hormuz open and priced in full restoration of 20 million barrels per day of oil flow. The physical reality was 4 dry cargo ships and $1 million tolls. That is a 96% capacity shortfall from pre-war levels. The oil crash that sent silver higher Thursday and Friday was based on information that was factually incorrect about the actual state of the Strait. When energy traders processed the real shipping throughput data this weekend, the oil piece premium reversed. WTI surged 7.14% to $89.94 Monday. Brent hit $95.71. And silver, which had rallied on the false premise of lower oil and lower inflation, gave back those gains. Here's the stagflation trap that silver is caught in right now and why this is temporary, not structural. Here's the paradox that is confusing every retail silver investor today. Silver is supposed to be a safe haven. It is supposed to go up during war, inflation, and geopolitical crisis. All three conditions are present. So why is silver down 2%? The answer is the inflation rate mechanism. When Hormuz is closed and oil surges to $89.94, inflation expectations rise. March 2026. CPI already came in at 3.3% year over year, the hottest reading since May 2024. If oil stays at $90, April and May CPI will be even higher. Every $10 per barrel increase in oil adds approximately 0.3% to annual CPI within 60 to 90 days. Higher inflation means the Federal Reserve cannot cut interest rates. Rate cut probability is currently at 52% for year-end 2026. If oil stays at $90, that probability drops to 30% or below. Higher rate expectations strengthen the US dollar index, which opened Monday at 98.31. And a stronger dollar makes silver, priced in dollars, more expensive for international buyers. Demand falls, price drops. So war pushes oil pushes inflation pushes rates up, rates push the dollar up, and the dollar pushes silver down. That is the trap. The very thing that fundamentally supports silver as a monetary asset creates the short-term mechanism that suppresses the paper price. But here's the critical distinction. This trap only works while oil stays elevated. The moment the Iran situation resolves, even partially, oil crashes. Inflation expectations fall, rate cut odds rise, dollar weakens. Silver recovers everything it lost, plus more, because the underlying physical shortage has been getting worse throughout the entire suppression period. Here is the physical market data that shows the paper price drop is completely disconnected from physical reality. While COMEX silver dropped to $78.94 this morning, here is what was happening in the physical market simultaneously. APMEX raised their American Silver Eagle price from $87.25 on Friday to $88.49 today. That is a 1.24 increase in the physical price. On the same morning, the paper price fell 1.56. Paper down $1.56. Physical up 1.24, moving in opposite directions on the same morning. SD Bullion's generic rounds went from $84.75 Friday to $85.999 Monday. JM Bullion Silver Eagles moved from $86.49 to $86.99. Every major dealer in America raised physical prices this morning while COMEX dropped. The physical market is not following the paper market down. Dealers are raising prices because their wholesale suppliers are raising prices because actual metal is scarce. The Hormuz closure does not create more silver. The 6-year deficit does not reverse. The 762 million ounces drained from global stockpiles since 2021 does not return. Physical dealers price on physical reality. COMEX prices on paper flows and geopolitical narrative. When those two diverge as sharply as they are right now with paper down and physical up simultaneously, the divergence always resolves in the physical market's favor. Paper converges upward to physical, not the other way around. Here's the ceasefire expiry scenario analysis for Wednesday, April 22nd, because this is the event that determines silver's next major move. Wednesday, April 22nd is 2 days away. The ceasefire officially expires. As of Monday, April 20th, there are 0 confirmed talks scheduled. Iran canceled the Pakistan meeting that was supposed to happen today. Trump threatened to knock out every power plant and bridge in Iran if no deal is reached. 3 scenarios play out from here. Scenario 1, extension announced Tuesday night. Both sides agree to extend the ceasefire without resolving core issues. Oil drops $5 to $8 immediately. Dollar weakens. Silver gaps to $83 to $86 at Wednesday open. The physical squeeze story becomes the dominant narrative as delivery pressure builds with May 1st notice day 8 business days away. Scenario 2, talks collapse Wednesday. Iran retaliates for the Tauska seizure. U.S. responds. Oil spikes back above $100. Silver initially drops to $75 to $76 on dollar surge and rate hike fears. But physical demand explodes simultaneously as fear of permanent supply disruption drives institutional buying. Physical premiums hit $15 to $20 over paper. The divergence becomes impossible for mainstream media to ignore. Scenario 3, status quo continues. No formal collapse, no formal extension. Ambiguity persists. Silver drifts between $78 and $82 all week, while COMEX delivery pressure builds silently underneath. This is actually the most dangerous scenario for shorts because it gives the physical squeeze maximum time to develop without a macro catalyst providing cover. In all three scenarios, the structural deficit does not change. The 76.88 million ounces of registered COMEX silver against 235.2 million ounces of May delivery claims does not change. The physical market pricing silver at $85 to $89 does not change. The Hormuz Lie created a temporary paper price distortion. The underlying physical reality is unchanged and getting tighter every day. Here is the IMF data on Hormuz recovery that Wall Street is not incorporating into price models. The International Monetary Fund published an assessment this month stating that even after a genuine peace agreement, restoring disrupted oil and gas output through the Strait of Hormuz could take up to 2 years. The infrastructure damage, the shipping insurance normalization, the rebuilding of supply chain confidence after months of blockade are not instant processes. That 2-year recovery timeline means inflation from energy disruption does not end the day a deal is signed. It fades gradually over 18 to 24 months. During that entire period, the Federal Reserve faces elevated inflation readings that constrain rate cuts. During that entire period, silver benefits from the monetary safe haven premium that inflation uncertainty creates. The Hormuz Lie created a false expectation that peace equals instant inflation resolution. The IMF's 2-year recovery estimate destroys that expectation with official institutional data. Peace is bullish for silver long term because it allows the industrial demand story to dominate. But it does not remove the inflation premium quickly. Silver wins in both the war scenario and the peace scenario. The only scenario where silver loses is the impossible one, where peace produces instant inflation resolution. Let me give you the one data point that proves today's drop is the buying opportunity, not the exit signal. On April 7th, 2026, silver hit an intraday low of $72.88. That was the bottom of the most recent correction. From $72.88 to Friday's high of $80.33, silver gained 7.45 in 9 trading days, a 10.2% rally in 9 sessions. During that entire rally, oil was elevated, the dollar was strong, the Iran conflict was ongoing. Silver rallied 10.2% despite every macro headwind that is supposedly crashing it today. It rallied because physical demand was absorbing every ounce of supply, because COMEX delivery pressure was building, and because the 6-year deficit does not care about daily geopolitical news flow. Today's drop from $80.50 to $78.94 is a 1.9% pullback within a 10.2% rally. In trend analysis terms, that is noise. A 1.9% retracement of a 10.2% move is 18.6% retracement. A healthy trend allows up to 38.2% retracement before the trend is considered broken. The trend is not broken. This is a shakeout within an intact uptrend driven by fundamentals that have not changed. Monday, April 20th, 2026. The Hormuz Lie has been exposed. The 36-hour peace celebration is over. Silver dropped from $80.50 to $78.94 on news that was always built on a false foundation. Oil is back at $89.94. The ceasefire expires in 48 hours. COMEX has 76.88 million ounces against 235.2 million in May claims. Physical silver dealers are raising prices while paper drops. The lie created a temporary distortion. The physical reality created a permanent foundation. And in every previous instance where these two forces diverged this sharply, physical reality won. This is the hidden AG. Do your own research. Consult a licensed financial advisor. This is education only.